Okay, so I think we might start. Good morning, everyone, and thanks very much for joining us to the first private client webinar of 2021, online, still in lockdown, but hope springs eternal after yesterday, hopefully anyway. I suppose just in terms of private client, and not to go through it again, but the service that we provide and the private client is probably best described as being at the intersection of individuals and their companies or corporates, or where they get their income from. And so the advice that we give and today is all about the interaction between either individuals in their own right or their companies, or a mixture of both. And so we are covering 3 topics today, as we have done over the last number of sessions. Negative interest rates is probably something that has been on a lot of focus has been on it. We'll touch on that. We'll touch on the investments aspects that arise in terms of negative interest rates. But in an economic context, where are these numbers? What are the numbers? As of December, which was the last main numbers given, there is, on personal deposits only, there is over 126 billion on personal deposits. There is another, and that excludes what's in state savings, which you could regard as deposits. There's another 20 billion on state savings. And then separate to all of that, there's another 75 billion of cash on corporate deposits. So from an economic perspective, there is an awful lot of money sitting there to be deployed if people are willing to deploy it. The other piece just to note on that, and I've touched on the negative interest rate, but again, from the economic piece, all we see, and again, yesterday, it was very much COVID, very much wait and see. But I think from the numbers on the income tax returns of 2020, and even January and February of this year, income tax returns to the Exchequer were 1% down in 2020 in comparison to 2019, only 1%. And the indications for 21 so far are that income tax returns are already ahead of what was expected and will be ahead of 2020. Now, that's all in the context of a global pandemic, huge number of people claiming benefits, but it is the lower paid workers are the people that are suffering most in terms of no employment, those working in the entertainment, in the pubs, in the hotels. From those that are paying income tax, the fall has only been 1% in a full year. So I think we're probably, when I say economy there's probably a number of economies operating within Ireland at this stage. And there's the multinationals, which is very well versed that they have had exceptionally good run over the last couple of years and last year. But certainly on the lower paid worker side of the economy, it has not been a good year, but the income tax returns and the corporate tax returns are not reflective of that whatsoever. From an individual perspective, I think what we would probably best describe the last number of months is people taking stock of where they are. To my earlier point, that is not alone their individual circumstances, but also their business circumstances. A colleague of mine was reported in the Sunday Independent last Sunday that on the corporate finance side, we have never been as active in terms of having mandates to sell businesses. We're going to touch on the tax aspects of that during the course of today. But I think what has happened, or what the time of taking stock has meant for people who are running businesses, is that those that were possibly thinking of passing on their business or selling their business over the course of the next 4 to 5 years have probably brought that decision or discussion around the decision forward and are taking it now while they have time sitting at home to think about it. On the individual side, in a personal capacity, people are more active in terms of looking at what do they have, how much do they have, and what do they want to have when they retire or during the course of their retirement. So we have a piece around deferred pension benefits and the quantum that exist and the options around it for people. And the other pieces I mentioned that we're going to cover today, which has become topical, particularly since AIB started issuing out letters to people, is negative interest rates and the impact of negative interest rates, and what does it mean for someone who is being potentially charged. Do they have to take any decision? We would argue no, they don't. They can just accept the charge. It is most unlikely that the charge is going to be reversed over the next number of years, purely because the banks are being charged for holding deposits, and that's going to continue certainly in the short to medium term. So I hope you get benefit out of the course of the next hour. We'll promise to be finished by 12:30 the latest. If you want to ask any questions, feel free to use the raise hand function and we'll address it towards the end. So without further ado, I'll pass you on to Liam, who's going to talk about, or sorry, Debbie first, to talk about the deferred benefits.
Okay, thanks, Ollie. So you may have seen this slide before, as we've used it a couple of times on our previous webinars to display how many different types of pensions there are in Ireland. So it's no surprise, I suppose, that in general, it can be quite common to accumulate a number of different arrangements throughout our careers and are at risk of having some old plans that do end up essentially forgotten. A regular conversation that I would have with a client or a pension scheme member is asking them if they have any deferred benefits. And I'm often told, oh yeah, I do, but sure, look, I was only in the company a couple of years, so it's probably not worth anything. Or if I ask who's looking after the pension, they might not even know. If I ask what fund they're investment in, they just don't have a notion essentially where they are at or what they have. Now, I can guarantee everybody on this call would know exactly what bank accounts they have, but when it comes to pensions, there is that disconnect. So there's estimated that there's well over 500 million of unclaimed pension benefits in Ireland. Now, unfortunately, unlike the UK, there's currently no centralised tracking service of deferred benefits in Ireland. This has been raised previously with the government, but I think the cost involved seems a big deterrent to even consider it. It does depend on the type of policy as to when it becomes classed as being unclaimed. And in the case of a personal pension, 5 years must have elapsed without communication from the life office or provider since the policy retirement date. Now, when the policy is deemed unclaimed, the net encashment value of the policy is transferred to NAMA, who essentially manage the funds on behalf of the state. Now, as everybody knows, compliance rules the world, and paperwork alone can put people off looking into old benefits. However, if you do remember the wonder of compound interest, even a fund of 20,000 in an employment from age 30 would have the guts of nearly 110,000 by age 65 if you assume a 5% growth per annum. So it is worth considering what deferred benefits you have out there. In general, there are two different types of deferred benefits. Those that originate from an employer or an employment, which would be classed as occupational benefits. Now, these funds are held in trust with a life office or pension provider and are completely separate to the assets of the employer. So even if the employer goes into liquidation or is dissolved, the funds are still there for the employee. However, as you can imagine, looking for these benefits later on in your career can be great fun, as benefits can move from an existing provider in a wind-up of a pension scheme when assets are moved to retirement bonds. We then have personal benefits such as personal pensions and PRSAs, and these are funds that are set up individually. Keeping information about each arrangement that you have is absolutely key. And we would usually say keep paperwork, or if you move address or change email, to let your provider or your broker know so that we can keep a track of you. If you have deferred occupational arrangements and don't know who to contact, your advisor can usually trace them. But if all else fails, the Pension Authority do have a list of occupational pension schemes in Ireland. Another consideration is if you've worked abroad, and we would regularly talk to clients who spent even a few years in the UK and accumulated a small fund there. Now, they might have no plans to ever return to the UK, therefore just exploring what options you have with these benefits makes sense all around, whether that's bring them back to Ireland or not. With each different type of arrangement, there are different rules on how you can access them and also when you can access them. So if we to take a deferred benefit from an occupational scheme or a company plan, or that which is moved to a retirement bond, you can actually access these from any time from age 50 once you've left the company, or you can leave taking them until age 70. whereas a personal PRSA or a personal pension arrangement can be accessed from age 60 or any time up to age 75. By knowing what type of arrangement you have, you're in a far better position essentially to plan for a drawdown, and you can phase your access to tax-free cash by taking these benefits at different stages rather than all together. There are different options available with the balance fund after the lump sum depending on the type of arrangement you have. So with a DC plan or a PRB, how your lump sum is calculated is one of two ways, whether that's by salary and service or by 25% of the fund value. So it's important to take note of essentially all the different arrangements, how you can access them and when you can access them, and therefore then plan accordingly. Now, it is important to note that you must take all benefits relating to the same employment at the same time and in the same manner. However, there is flexibility in how you access your deferred benefits. So to consolidate or not is something that we do discuss quite regularly, and it does depend on the individual as to what they're comfortable with and what I suppose is more important to them. Whether it does also depend on the size of the fund and when they plan to take retirement. Keeping track and managing benefits is a lot easier if you only have one or two plans. However, if you have a couple of plans, you can have the flexibility then to enable you to have a retirement plan where you phase your access to cash and essentially plan for retirement over a number of different stages throughout your later life. Now, a defined benefit arrangement was probably traditionally seen as the holy grail of pension, as it's a promise of a lump sum and pension based on your service and pensionable salary in an employment. But you do need to consider the value of the benefit from a cash flow perspective versus maybe inheritance or family protection. So on this slide, we have a case study outlined, which was a real scenario that we had where we had a male who was age 65. Now, he was a widow with 2 adult children and 5 grandchildren. The defined benefit plan that he had, which was a deferred benefit, offered him a lump sum of 42,000 in cash and a pension of just over 10,000 per year with a guaranteed period of 5 years, and it included a 50% spouse's pension. We asked for a transfer value, and the transfer value allocated was 387,000. Now, he was in employment, in full-time employment, and he also had a fund of just over 250,000 in that employment. He'd no mortgage, no need for cash, and he also had no plan to retire for the next couple of years, albeit that he did plan to step back within the next couple of years. So when we met him to discuss how important the idea of essentially guaranteed income was, in comparison to having a flexibility maybe in his retirement, it proved that the conversation moved straight away from having guaranteed income and actually just wanting to make a plan for his family, that in the unfortunate event of his passing, there would be income or funds there for him. By also considering the transfer, we were enabled to delay a drawdown up until age 70, though he knew he had the flexibility to access it at any point if he wanted to beforehand. He would get 25% of the value at drawdown as a lump sum, which was higher than he was getting under the defined benefit arrangement. And then the balance fund would go into an ARF plan where he could draw down at least 4% per annum. Now, his plan is with an investment strategy in line with his appetite to risk. We will hopefully cover the withdrawal each year. Obviously no guarantee in that, but that is our plan. Now, the reason he opted for the transfer value was primarily down to the fact that it met his main requirement, that was in the event of his death, the funds would be available to his children, albeit with a tax implication. Now, on this next slide, we look at the transfer matrix, and this gives an overview of essentially what transfers are permissible. So you can't go from a personal retirement bond to a PRSA, but you can go from a retirement bond to a company plan, and from there go to a PRSA. So when we look at the overall arrangements that somebody has, it's about structuring them in the most tax efficient manner for them at retirement. Now, as you can see on this, pension simplification is badly needed in Ireland to help with this disconnect that we all feel between our pension arrangements, especially on the group member space. So if you do have deferred benefits, it is important to understand exactly what you can do with them. So to summarize maybe some takeaways for you, I would encourage everyone to maybe get a summary together of all their benefits that they have. If you've worked abroad, capture these to see what options are available to you. Review your fund strategies and structures of each of the arrangements and get advice how to manage them all in line with your overall appetite for risk and also your overall financial circumstances and retirement plan. And lastly, if you have a defined benefit plan, request an updated statement, work out what your promise of pension is, what you're likely to get from that pension, and also request a transfer value so you can evaluate the options, taking into consideration your overall personal circumstances and financial goals. So I'm going to pass you over to Liam, I think.
Thanks, Debbie. Good morning, everyone. So there's a couple of things that we'll probably retread here today based on what we talked about last September and October. I think over the last 12 months, we've seen a lot of change in the world. This time last year, we were in the middle of a recovery from a fall in stock markets that happened from February until March. So I think a lot of people are worried about negative interest rates. They're worried about what's happened over the last year. And I think people are starting to see more of an emotional attachment to their money, where they're saying, I don't want to leave my money in the bank if I'm going to be charged interest. But our argument is to say you need to find reasons why you're going to invest rather than just saying, well, I don't want to be paying a rate of interest on my money. So there's a couple of things we'll go through here, and it's more trying to align how you will invest your money based on what you're actually investing for. Because if anyone turns around and says, well, I've got X amount of money in my pocket and I need to put it away, that's the most open-ended question that you could ask. What am I supposed to do with it? Well, what do you need it to do? So there's three charts we'll look at here, starting with long-term performance. Long-term performance could be classified as anything from 15, 20, 50 years or more. We'll keep it more relevant here by looking at the last 15, because typically, even if people are invested for all their lives, they'll have specific investments for specific reasons that would probably average around the 10, 15, 20-year mark. So looking back on what's happened over the last 15 years, there's no real surprises in the long term. So if we take a look at the 4 lines that we've got here, we've got the average return on different types of funds in Ireland. So this isn't any particular funds. It's just looking at the average global equity fund, which is the red line. We've got the average managed fund, which is more than 65% in equities, because equities will drive returns and also short-term risk. So that's the focus, why we focus on what the equity content is in these. We've got the managed balanced average fund, which is between 35% and 65% in equities. And we've got the managed defensive fund, which is less than 35% in equities. So looking at the last 15 years, it's quite straightforward, where the lower risk you take in the defensive fund, the lower the volatility in certain times of underperformance, but also the lower long-term returns that you've generated. And then if we go up the risk scale, we see that the balanced average is the next in line for fluctuations and returns. And then as we work our whole way up, the average global equity fund has performed a lot stronger than the rest. Now, this isn't tracking markets. The average fund that we have here is trying to take the average equity fund or managed fund that's in Ireland and pool them all together, because we're not going to talk about anyone specifically today. You would expect an average global equity fund figure is probably behind market performance. That's for a couple of reasons, really. First of all, if you're a passive investor, you need to find a passive solution with the lowest tracking error to get you as close to the benchmark as possible. But then if you're an overly active investment manager, if you make some really good calls, you might outperform the market. But if you make some poor calls, you might underperform. So this isn't just saying what the market would have returned. So if you look at the average figures there, we've got 6.67% gross average for average equity fund, and this is since 2006. So we're a couple of years in getting some positive performance before we hit the financial crash. So really what we're taking into consideration here is the financial crash, 2007, 2008. There's a bit of volatility in 2016, 2018, and of course last year. And we'll look at that a bit closer in a second. But it's all about trying to fit, what am I trying to do with my money? Because if I'm going to be exposed to 100% equity funds, well, if I need my money next year, I can't really afford to be exposed to that level of risk, even though long term I know the potential rewards are higher. So it's all about trying to fit in, what am I investing in and for why. So if we move on to the next slide, it's just to look at what happened last year in just 2020 itself. So this time last year, we would be in the throes of a week-long recovery so far. I think I told a story in the last one where I spoke to a client on the 18th of March last year with a retirement fund that had fallen quite significantly. He would be more in the managed aggressive type of fund. So his retirement fund was falling. He gets an income from it every month, and that's his income in retirement. He doesn't have any other income or any other assets. And he was starting to panic, starting to feel really insecure about what to do, had benefited from growth over a number of years, but it was a long time since he'd experienced such a fall in markets. So the conversation went the way it always goes. It says, right, let's take it back. Where are you invested? How long are you invested for? You're not invested for the last 6 months, the next 6 months. And the message was, a recovery will happen. We just don't know when. So will it happen in 6 months? Will it happen in 12 months, 18 months? We don't know. Now, luckily, it was a good conversation. The client decided to stick. And 5 days later, a recovery started. So if we look at what's actually happened over the course of 2020, again, markets fell significantly over the course of 20th of February until the 23rd of March. If you were exposed to any investment risks, your fall was relative to the amount of risk you were taking. So just because the news starts saying that, oh, markets have fallen by 30, 35%, that doesn't mean your money has. If you're a short-ish term investor, you're taking a slightly lower level of risk, well, you may have been experienced to investment risk, such as the green line here, which is the average defensive fund. You were still down to bones 10%, which a lot of people think, well, I'm taking little risk, so I'm not exposed to such fluctuations. We really have to look at the more, not extreme scenarios, but how much risk you can be exposed to based on what you're invested in. And just to look at the fall that happened there, everyone says, well, you know, how am I supposed to experience this? Or I'm worried about what's going to happen over the next while. Have we recovered too quickly? And so on. If we actually look back in time, and if we take the S&P since 1928, I think it's once every 9 years on average, the S&P has fallen by 30% or more. And if we take that back to 15%, it's once every 2.5 years. So we went through a period of almost a decade of just no volatility. There was a bit in 2016, a bit in 2018, but people were very comfortable with, if they didn't look at their funds for a year, 6 months, if there was any volatility in between, it tended to be wiped out. So people need to get more comfortable with the idea that risk is back. Well, it probably is back. We can't guarantee anything. We might have another run like the last or previous 10 years now, but people need to get more comfortable about, well, what risk is potentially exposing me to the market, but what am I investing for? Because volatility it's a fee rather than a fine. You're paying the fee of volatility to get something in return, which is long-term returns. It's not a fine. A fine is when you do something wrong. So it's very important to distinguish between the two of them. So if we just move on to the next slide then, and we look at basically timing the markets. We'll always say that you can't time the markets. If someone says they can time the markets, they'll probably be right a few times, but they'll probably be wrong a few times too. I'd argue they'll be wrong more than they're right. If you were unlucky enough to invest on the 20th of February last year, nobody would have known that was the date that you shouldn't have invested if you wanted to try to maximize returns. But recoveries do happen. They always have happened. Anytime there was a fall in markets before, now looks like it was an opportunity to invest. So there's no reason why future volatility and future falls in markets won't be another opportunity to invest. Now, the recovery was quite quick. It was the fastest fall, the fastest bear market ever, and it was extremely quick recovery. There is no guarantee a recovery happens this quickly again. But over time, again, if we align your investments to objectives, we can figure out how much risk should you be exposed to on the downside, but also what kind of returns are you giving up by being afraid of volatility where you really don't need to be. So if we move on to the next slide and we start looking at the practice of deciding what you're going to invest in, we'll always come back to here. Everyone's worried about negative interest rates. Everyone's worried about volatility last year and what happens if it happens again. Well, it will happen again. We don't know why. The last few occurrences of shocks to the stock market, they're not for reasons that we see coming. So everyone would have thought that the next recession might be caused by Trump, or it might be caused by stuff that the central bank is doing. But it's the things that we don't see coming is what caused these shocks. So take, for example, coronavirus, the collapse of Lehman Brothers, even 9/11. It's these things that we don't know are coming, but so we better plan for them. So no matter what you're doing, if you're investing for pension, personal money, if you're a corporate, it's always best to pull back and say, right, what principles do I have to sit here or set? So the first 4 points, if we work anti-clockwise in a circle, are what we have to look at when we're getting ready to invest or deciding what we're going to invest in. And then the next 4 points are how we behave while the money is invested. So first of all, we need to set an objective. If you don't know why you're investing, you probably shouldn't be investing. So you mightn't be able to come up with the specific reason to why, but if you sit down with someone and really eke it out, you will definitely be able to make a plan that says, right, I need money for X, Y, and Z reasons. It could be anything. It could be children's education. It could be inheritance down the line. It could be retirement planning. So trying to set that objective is really important. The time horizon, again, is massive. So if we look at what happened in the last few charts, the longer you're invested for, the more you can take the short-term risk. For example, pensions, if you don't need money over the long term, and we take Debbie's example previously, over 20 years of compounding interest, my pension is in 100% global equities. I don't need it for another 30 or 40 years. God knows when I'll need it. So I'm not worried about falling markets. So if it's long-term investing like that, well, then we should be aligning our risk to how long our money is going to be put away. Risk tolerance, again, is very important. So if we look back on the other 2 previous points, if you're a low risk investor and you really can't take it, and even though you don't need money for 10, 15, 20 years and you're putting it away, if you know emotionally you're going to do something incorrect when the bad times come or there's a fall in markets, you either need to find someone who will make sure that you don't make those mistakes, or you shouldn't be exposing yourself to risk that perhaps the objective in a time horizon would suggest that you should be going into. Lastly, on pre-investment point is diversification. We've gone through it before, where there's a number of ways to diversify, whether it's through institutions, investment managers. Two of the key ones are diversifying asset classes, and that will depend on the level of risk you're taking. So if you're taking higher risk, you'll probably be more predominantly in equities and maybe a bit of property. And if you're lower risk, you'll have more of an exposure to cash and bonds. Another way to diversify, which I think is very important, is actually within the asset classes themselves. So if you're investing in an equity fund, how many stocks is that actually invested in? Is it 20, is it 50, or is it 1200? We'd always argue, again, especially for longer term investments, that if you can just capture market returns, it's really hard to do much better than that, especially over a 20-year period, for example. When the money's invested, then the next 4 points are probably going to determine how successful you are in the investment, rather than picking the best fund within the second level of risk that you want to take. Avoid market timing. Again, I don't think anyone can tell you what's going to happen tomorrow or the next 3 months or next 6 months. They can absolutely design a fund to maybe limit downside risk or try to capitalize on something that's happening in the short term. But if you're trying to do that constantly over the short term for a long period of time, it becomes very difficult to be right more than you're wrong. Managing emotions, I think, is huge. An example being the client I was talking about a minute ago with his retirement fund last year. He knew before he retired that he was going to have to invest his money for the long term. He knew that there was going to be ups and downs along the way. Over a 10, 20, 30-year period, we should always be expecting ups and downs along the way. But it's when it actually happens is when people behave in a way that they didn't expect. So we make decisions logically based on the first 4 points. But then when things actually happen during investment strategy, we start to think illogically because our emotions take over. Filter through the noise is very important. All of the noise that's out there with 24-hour media, it's just constant negative clicks. You won't get clicks for positivity. I'd say if we sent out an email for this webinar and tried to make it as negative as possible, we'd probably get twice as many people responding to it. But it's all about just saying, right, why am I investing? What am I investing for? And then focus on what you control, and we'll come back to that on the last slide. So moving on to a couple of very important points, I think, is that people will always come into us and they'll say they're investing for a reason, or they want to invest for a reason. So on the left-hand side tends to be the reason why the client comes to us, and on the right-hand side is what we need to eke out from the client and try to make a plan with them. So first of all, very topical at the moment, and probably why a lot of people want to talk about this kind of stuff: negative interest rates. What should I do? I don't want to be paying a charge on my money. Well, what are you investing for? If you're just putting money away because you don't want to pay an interest rate, a negative interest rate, well, if it's for a year or 2 years, it's probably better to suck it up. If it's even 3 or 4 years, you're probably better off to suck it up and just take it. You are exposed to a lot more risk. For example, last year, defensive funds fell up to 10% on average during a correction of a month. So why would you be taking such downside risk over a short term when you know what you're going to get on the other end if it's short term holding of cash and negative interest rates? So setting goals and setting your investments based on goals is key. It gives you a time horizon, and it gives you the discipline to say that if something happens where there's a negative period, well, if the objective isn't going to come to fruition until another 10, 15 years, or even 5 years, you've plenty of time to try to recover from what's happening in a correction of markets. Another one that people come to us with is excess cash. So I have money, it's in the bank keep on ringing me, or someone else keeps on ringing me saying, well, you have that, what are you going to do with it? And I'm better off locking it away to do something. Well, first of all, we don't like the phrase lock away, because that tends to mean that people are locking their money into something for a period of time and can't get it out. Any investments we'll talk to people about will be purely liquid investments that they can take out at any point. They're priced daily. But again, it's just if someone has cash sitting on a bank account, that's no reason to invest again. It's what are you investing for? So if it ends up being excess cash that we can sit down with you and identify that it's not money you need in the short or even medium term, well, then if it's long-term money that you just want to grow, you should be at least trying to grow it in line with inflation. But if you've got so long to leave it alone, well, you should definitely be trying to get a higher return on it again. Retirement planning is another thing. And of course, we see it a lot under the private client umbrella, because we deal with so many people that are doing their tax returns inside in GT. So if someone comes along and they say, well, I have to make a pension contribution because I want to get the tax relief and lower my income tax bill, that's fine, but they completely forget about the upside of the tax-free growth within the pension. And yeah, you'll pick a fund and you'll invest in it, but if you don't engage and see the benefit of what actually happens when the money's in there, well, you'll probably end up having a worse outcome than you would if you took it a bit more, I suppose, seriously, or sat down and had a chat about it. So you might get 40% relief on a contribution that goes in, or you might end up be benefiting from a lump sum from a company paying a pension contribution into your fund. But the benefit of the tax-free gross roll-up, it's the most tax-efficient investment you can have in this country. So why wouldn't you benefit from it? If you're 35, 40, 45, and there's money you don't need for 20 years or more, well, you should absolutely be taking a higher level of risk with it than you probably would with your personal investments, because you probably need them a bit sooner. And also, it's really important to remember that the majority of the time these days, things can always change before you retire. Most people are going down the retirement fund route now, so their money ends up being, well, 3/4 of their money ends up being invested from now until the time that they die or their spouse dies, rather than just being invested at age 65. Again, pension lump sum is another reason why people will want to invest their personal funds. They have a lump sum that they've drawn out from their pensions because they're 60, 65, 70, and they'll say, I need to do something with it because I don't need it for income. Well, I'd argue if you don't need it for income, maybe you didn't need the pension for income in the first place, so you should have left it alone for a while to get some more tax-free growth. But at the same time, you need to make a plan for that, because if people have a lump sum that they don't need for income purposes, they should be putting it away for a relatively long time, even if they think that they're old, and that's all relative again. But then on the other side, people will take their pensions for income, they'll have a lump sum, and then they might say, well, I'm going to keep that in cash because I don't like investing everything. But if it's money you actually will need to be worth more for you in the future, you should definitely be doing something with it. And it's trying to come up with a plan for that. You might need to provide an income on an annual basis from an investment, and that should be a much different investment than one that you're putting away and not touching for a long period of time. And then how you invest, I suppose, is the next topical conversation that's coming up at the moment on the next slide. So it's, people are now conscious of, I've got this money that was sitting on a bank account, or I also see that markets experienced severe corrections last year for a short period of time, and people are starting to become a bit more emotional with their investments. You can absolutely invest as a lump sum, whether it's personal money or whether it's pension. It depends on how you're structured, but if you are making an investment decision and there's a lump of money there that would be considered quite large, you can invest it in one go. You can also decide to do it over time. There's also types of investments that you'll be doing that will be averaging into markets rather than lump sum investing. Like if you're doing regular savers, if you're doing child savings every year to give them $3,000 tax free over time, or even if you're contributing to your pension, whether it be monthly or annually, that's still averaging in, because over the long term, you've an awful lot of different investment dates. So there's pros and cons to both. If we take it just from the left-hand side down to start off with, if you look at the studies that have been done on lump sum investing versus averaging into the markets, typically 2/3 of the time over rolling periods, you would have actually been better off investing the lump sum on day one, because it tends to give you a longer investment period, and the longer you're invested for, the higher probability of a positive result and the higher probability of higher returns. If you average into the markets, you tend to cover the downside a bit more. So you might not benefit from such a high investment return than if you invested in day one. But if there's a correction in markets over time, you tend to not have such a significant fall because money is going in at all different periods. Lump sum investing can be a bit more emotional, because if you have a big lump sum you need to put away, it's going to be valued on a specific investment date. So if someone had 500,000 to do, whether it was put away through pension or through personal money or a corporate, and they decided to invest it all on the same date, well, it's always going to be valued based on a performance from that date to the day it's been valued. Whereas if you go into the market over time, well, you're potentially smoothing your returns or your investment journey. But instead of looking at the performance of the 1st of January 2014 to today, what you're actually looking at is, well, I've invested money all the time, and my investments are not based on one date to another. It could be based on hundreds of different dates. Lump sum investing is easier to facilitate, and when I say easier to facilitate, I don't mean it's easier for us. I mean it's easier for a person once they've made a decision. Once they've made a decision, the money's invested, it's in there, and now it's a case of behaving yourself. Whereas if you're averaging into the markets and you say, I'm going to put X amount in every month or every quarter or every 6 months, if there's some negative news in the time between investments, you might turn around and say, well, maybe it's not a good time to invest now. Well, our view will always be, no one knows when's a good time to invest. The last contribution might have been a bad time to invest in theory, but this might be a very good one. And if there's been a fall in markets, even if there's a further fall, well, we would see that any fall tends to be a discount in price over the long term anyway. And then for a lump sum investment, the one thing I would look at potentially more on lump sum investing rather than averaging into the markets is that you can split your risk levels with a lump sum. You can do it with any type of investment, but it's more key for a lump sum investment. So you might decide, I'm putting away, again, it's $500,000 as a round number, but I might need income at some point, even though I know the majority of the funds won't be put away, well, it will be put away for a long period of time. Well, then you just segment it where you say, okay, a portion of my funds will take low risk, a portion will take more medium or higher risk. But I know that if I need income, that I will have a portion of my funds not exposed to such high risk. But then if you take pension funding, whether you're doing it monthly or annually, if you're averaging in, I would argue you can take a bit more risk again, because if you are averaging in, you are probably going to do it over a very long time, potentially 20, 30 years. And then when you're doing that, when markets fall, you probably want to be investing in riskier assets anyway, because what that will do is, as your current fund value is recovering, any additional contributions you make will benefit from growth while the recovery is happening. So if we move on to the next slide, it's probably more of a complex investment journey, I suppose, when you're in retirement. And we've just got 2 quick slides on this. We went through this before, but we're looking, if you're doing pre-retirement funding, you're looking at putting money in over a period of time. You might take more risk because it's a longer term period. If you're investing personally, it depends on what the purpose is. If it's for 5 years, 10 years, 15, you've got a defined period of time, and you might be taking any money out. Now, when you get to retirement and you have a retirement fund, your funds will probably be invested until the day you die. Unfortunately, some people will invest their funds and they will lose out on the value and it will deplete before they die. Most of the time that will happen because they're not taking enough risk, whereas some people would say, well, I don't want to be taking risk of my pension. The biggest risk you can take in retirement is not investing in your retirement fund. But in Ireland, on average, people are taking too little risk. So if we look at just a real middle of the road kind of portfolio here, in terms of risk for retirement, what you want to do is you want to take enough risk to generate sufficient returns to provide you with the same income in retirement, but also you want to be able to provide an asset for your family. So if you are invested in medium to high risk funds, we won't go into detail there, but if there's a correction in markets like last year, or typically people take income from their retirement funds in December. So if we go back to the last quarter of 2018, there was a fall in markets coming up to the end of 2018, and then everyone took money out of their retirement funds. So what they did was they consolidated their losses on the portion that they took out, and then the funds recovered relatively quickly, like you would always expect them to do, but you're starting from a point further back. So if you can split it and you can say, right, what I want to do is with my total retirement fund, I want to take X amount of risk. And in this case, we've said someone wants to take about 65% of their funds trying to grow the value of their money, 35% trying to preserve the value of their money. So preservation is more cash and bonds, growth is more equity, property, maybe a little bit of higher risk bonds. But if you set your benchmark, what you can do then is you can try to say, okay, how do we structure this so that we can safeguard against money coming out of our funds? Well, if we could put a portion of our funds in lower risk and then have the majority of our funds around our benchmark, we can then take another smaller portion and take higher risk with that. And depending on the level of risk, that's how we order where we take income from. So if we go on to the next slide and look at how this actually would have happened in practice over the last number of years, we've gone back 7 years, but there's 2 things that I probably want to look at mostly. The first one is in 2018. So in 2018, on the last quarter, people were taking their money out in December and we had a fall in markets. And sorry, we just have to move on to the next slide to look at this. If we look at the just coming up to 2019, you can see, especially if we look at the green line up at the top, that there's a fall in value coming to the end of 2018, start of 2019. People took their money out then, consolidated some losses. But if we can structure it where we put a portion of funds into a lower risk portfolio, a portion into the middle of the road where we want to go, and a portion into higher risk, what happens is we take our income from the lower risk fund. So you can see the orange line at the bottom there, it's the more defensive fund. The fluctuations aren't as great around 2018, 2019 there. Still a significant fluctuation last year, but still relative to the higher risk funds, a lot less. If you can take your money out of that, your income out of that, this also works for personal investments, paying you an income. You are then allowing yourself to have higher risk funds untouched after a correction, and then they will grow faster in a recovery, which will help you maintain the value of your fund over the long term a bit better. So the red line and the yellow line are, the red is the portfolio that we put together with the 3 different investment options. The yellow is the benchmark, or it's a little slightly higher risk than our benchmark, but you can see that we try to follow the performance of where we would be if we selected a portfolio totally for that level of risk, but by just managing it in a way where we've got longer term investments taking more risk and shorter term taking less risk. When you take money out, you can add a lot of benefit to yourself there. So then if we just move on to the final slide, and I think this is probably key in terms of what we tell people or talk to people about, is that everyone is obsessed with returns, and we need investment returns. We need them for specific reasons for different portions of money, whether it's personal money, whether it is pension money, whether it's corporate money. we're obsessed with returns, but the returns that we'll get in the future will be determined by what happens in the world. So if markets are up and they're up more on average than they had been over the last 100 years, that's brilliant for us. There's also the potential that on average they could be lower than what they were performing like for the last number of years. But if we can just manage the risk we take, the time we're invested for, and how we behave during the investment experience, that is going to have a huge impact on the return we get at the end. It's not trying to pick the best fund in a certain category. That's really important, I think, from an understanding perspective, that people understand how their money's invested, because that feeds into the behavior. But if we can control what we never focus on, risk, time, and behavior, that will result in more positive outcomes than trying to always find the highest returning fund. So thanks for listening to me waffle about investments for the last few minutes. I'll pass you on to Una now to finish up. Thanks very much.
Thanks very much, Liam. So I suppose Ollie started this webinar by stating that corporate finance activities are up, that we're seeing a higher mixture of sales and probably acquisitions in the Irish market. And I suppose one comment that struck with me was that he said an awful lot of people are probably just sitting at home thinking about what they're going to do with their business or how they're going to expand it, or even, and the subject of the topic for today is, are they going to sell their business, or are they going to retire from their business? There is an awful lot of things that need to be considered, and obviously I'm coming at it from the tax perspective, and I know it is quite emotional, the decision to either sell your business or to pass it on even to the next generation. There's a few things that we see from a tax perspective when they come in is, well, how will an exit be funded? If you are leaving the company and you're doing it as an MBO, as in a management buyout, are you going to leave the business's entirety? Is there an actual purchaser, or is there children involved? So I've been doing these webinars with Ollie and the team for the last couple of months, and you will note that I have covered share buybacks, I have covered MBOs, and I touched a little bit on the third-party purchaser. We also did an awful lot of retirement planning for children and passing to the next generation. I suppose this purpose of today's webinar is to really talk about it from a sales perspective, that we're actually selling our company. And this is in line, I suppose, with the fact that the corporate finance market is quite buoyant at the moment. And then also, I suppose the thing that people don't realize as well is that when you do succession planning, you're passing on to your kids, and it might necessarily be that you get a lump sum. So even though you want to retire and you want to exit and you want to pass it on to your children, a third-party sale might be more realistic, or you just mightn't have any children that are interested in the business. So I suppose what we'd say is, and it is a long-term process and it is emotional, you plan ahead to identify exposures within the business. Can anything be done? And I'll talk a little bit about that. When I say can anything be done, is there a huge amount of cash on the balance sheet? And if that's the case, then we need to run straight to Ollie and Liam and Debbie, because we can go and do a bit of pension planning, we can do termination planning. You've just listened to Liam talk about investing cash. Is there a way that we can get some of that cash off the balance sheet to invest in products? But bearing in mind, would it impact any of the reliefs that are available when you do go to sell, or when you do go to pass on to the kids? Again, very much is understanding the nature of the assets on the balance sheet. So while cash is a great thing, and you obviously need cash to run your business, the Irish Revenue don't like excess cash on the balance sheet for the various reliefs. So retirement relief, business asset relief, entrepreneur relief. They feel that if you have too much cash on the balance sheet, it's almost like it's an investment company, it's cash rich, it doesn't have huge value from trading activities, which to a lot of people who are listening in on this webinar are like, but your cash is king. You need cash in order to run a business. Why would Revenue say that you can't pass on shares, that you can't sell shares with huge amount of cash on it? But unfortunately, that's just the lay of the legislation at the moment, and we do have to work on it. So as I was saying, cash, there is other ways that can be maximised. Can you fund pension payments? We listened to Debbie talk about all the various pensions and being able to ensure that you have a pension when you come to retire? Is there a way that the company can use that cash to fund your pension payments, to fund pension? Can we leave aside some money for termination payments? Just a quick note on termination payments, though, is that you must actually retire from the business. You must actually cease your role. And with an awful lot of sales, you might have a period where you have to be retained in the company, and termination payments mightn't work in that case. Valuations, not so important when there's a sale, because obviously it's two parties coming together. They're negotiating what they think either one party will sell for or what the other party will buy for. But where it's succession planning, valuations are key. And it's not what the dad who's passing on to his two daughters thinks the business is worth. It's essentially what a third party valuer will consider. So just kind of bear in mind all those sort of things as we move through the slides. So when you are preparing for sale, you do have to look at your company. You do have to look at your group. If it's a group, you have to decide, okay, what am I selling? That building that I've had for years, does the purchaser want that building? Do I want to keep the building? If I keep the building, how do I get it out of the company? I've got a company since 1981. The purchaser is a bit hesitant about buying the company and all its historical liabilities and all its tax history. Is there any way that we can move out the trade into a new company and package it up and sell a new company? If they don't want that, is there a way that we can look at it? And then we're into tax due diligence, we're into warranties and indemnities, and I'll touch a little bit on that. Then we need to look at, okay, is our company wholly or mainly trading? Do we have a huge amount of investment assets on the balance sheet? Is there anything that we can do to reconstruct? And you'll hear me say that, restructuring. Is there any way we can restructure the group so that we can maximize the use of reliefs? So if we just move on to the next slide, please. Basically then, if we have a group company, we can just we can either decide we'll sell at the shareholder level, or we can sell at the parent company level. So you'll have often hear people talk about participation exemption, or another word is substantial shareholding exemption. And what this means is that the parent company can sell a subsidiary, provided it has more than 5% of that subsidiary completely tax-free. So you actually, parent company pays no tax to the Irish revenue. This works, and this is why it's very important that you have to sit down and have a chat through. This works where the shareholder wants the subsidiary, has ideas for the cash in the parent company, either wants to go and invest, either wants to go and acquire a new business, has its eye on different things, and it wants all that money. In this case, this structure works really well because the parent company sells, pays no tax, and is left with essentially a cash box. However, you do have to consider, if they have been using this as part of their retirement planning, they need to get the money out of parent company. If they liquidate out of the parent company, it is a pure cash box at that point in time. Is if you do like the idea of this, and that's what this next slide will show, if you do like the idea of participation exemption, you can put in a holding company structure, and this can be done quite tax efficiently. So basically NewCo can be put in that will be the 100% parent of TradeCo, and you can avail of that participation exemption. And this will be the case where Una and Ollie are very happy to be in business together. They had a great company, TradeCo, but they have their eye on other acquisitions now, and they basically want that all the money intact, and they want to move on to further investments, further opportunities. So this can be done quite tax efficiently. There are other things that you need to consider. So if we move on to the next slide. You can, as I said, you can get participation exemption, but there may be a restriction on entrepreneur relief or retirement relief. And that's one thing that you have to be very careful for retirement relief.